In this video, we're going to be looking at the MACD and the MACD histograms in practice with some live examples. But before we begin, let's look at some of the objectives that will be discussed in this video. We've got the calculation of the MACD, the concept of detrending, signal line and zero line crossovers, overbought or oversold analysis with the MACD, otherwise known as OBOS analysis, and we will finish with a couple live examples of MACD divergence in action. So let's begin with asking ourselves, what is the MACD? What does it stand for? A lot of people use this term without knowing what it stands for. Well, the MACD is called the Moving Average Convergence and Divergence. And that was created by Gerald Apple. Yes, like the business, Apple. And it works by detrending two moving averages to create an unbounded oscillator. And the fact that it's unbounded means that it is not forced to oscillate within a certain range like the RSI or stochastic oscillator, which are normalized to stay between 0 and 100 at all times. It is conventionally displayed with the signal line and a histogram. The histogram is calculated by detrending the MACD with the signal line, and it's a form of doubly detrending price, and we'll cover what detrending means in just a moment. But we should also look at some of the default parameters for the moving averages used, which are two moving averages, and these are two exponential moving averages, nothing else. Two exponential moving averages with periods of 12 and 26 respectively. And we've just pulled up a diagram that shows what a MACD looks like. The red line, we should probably walk through here, is the actual MACD. And the grey line following the MACD is the signal line, and the grey bars running through the middle are the parts of the histogram. These are the histogram. Now, what does detrending mean? Well, it's a way of plotting momentum. The trend component is removed by calculating a longer and shorter moving average and subtracting the longer period moving average from the shorter average. So let's get the formula up just whilst we talk about it. But essentially all you need to know is that this formula, the MACD, plots the spread between the two moving averages. So as we've got on the screen, the formula for the MACD is a 12-period exponential moving average, or EMA, and then you take the 26-period exponential moving average away from that, and that gives you your MACD, which essentially, as we said, is the spread between the two moving averages that you've decided to use. It plots that for you. And a signal line is just the short moving average of the actual oscillator values. So in the case of the MACD, the signal line is conventionally calculated as a 9-period SMA of the MACD values. Note that this is not an EMA, it's a simple moving average. But you can also use an exponential moving average, otherwise known as an EMA, instead of a SMA for the signal line calculation too. That bit is totally up to you. Now we have a chart here that will help you understand what the MACD is actually showing and the numbers going into it. We've got a price chart which also shows the two moving averages used in the MACD calculation. You've got the 12 and 26 period EMAs. Just for the reference here, the 12 period is plotted in blue. That bit, we have it plotted in blue. This is literally the exponential moving average plotted on the graph instead of on the MACD area, just to try and make sense of this. And the 26 period is plotted in yellow. You can see the data throughout here with respect to price in this circumstance. And remember that the formula is essentially the blue line minus the yellow line. Remember, the blue line here minus the yellow line gives you your MACD. So when the blue line is above the yellow, in this circumstance we could use that. You got the blue line above the yellow, then the MACD is positive because the difference between this point is positive. But when the blue and yellow lines cross over, as marked by the 4 vertical dashed lines, the MACD crosses through the 0 line. You can see they cross through because the spread is 0. Look, they cross. The difference between the two of them is 0. Because think about why that makes sense. When the moving averages cross over, they have the same value. So when you subtract one from the other, the answer is 0. There is no spread between them because they are equal. So let's introduce how the histogram values can get calculated. So the histogram goes a step beyond the MACD by doubly detrending the price data. And we mentioned this in the introduction of the video. Well, you're probably asking now, what does that mean? Well, we know that the MACD is a standard form of detrending the price data. And the histogram goes a step further by detrending the actual MACD values, which have already been detrended. Detrending the MACD is done by plotting the spread between the MACD and the signal line. And the formula is simply the MACD minus the signal line. The faint grey horizontal bands running along the MACD were drawn simply by looking for the levels where the MACD has historically had a tendency to become overbought or oversold and reverse. It's kind of like resistance and support where you have in normal price charts. But in this case, you can see that the indicator will find support across the bottom and resistance across the top at the same historically significant levels over and over again, which can be used to our advantage. You can also see how the oversold periods, highlighted in green or yellow, depending on your brightness of your screen, these oversold periods seemed to have coincided well with price lows and presented good buying opportunities. And in similar fashion, the overbought MACD, highlighted in red, so these small strips, vertical strips, accurately identified tops in the market. Look here, overbought area, market reverses from there. Interesting. An oversold area, market reverses, but this time it's a positive sign in comparison to the prior negative sign. And another simple way to interpret signals from the MACD is via signal line crossovers. Now, we mentioned this at the beginning of the video, and we'll hopefully go through it in some detail for you now. The MACD crossing above its signal line is considered a bullish signal, and the MACD crossing below its signal line is considered as a bearish signal. And this method is generally more effective when the crossovers occur in overbought or oversold conditions and when the MACD is reversing from a strong trend. Here's an example of signal line crossovers generating signals in daily oil prices. The indicator gives reasonably accurate signal line crossover signals during the first half of the chart. You see, you have that signal line crossover a little earlier, price actually follows towards the downside, then you have a crossover here, signal line crossover, and then price actually moves up in line with the bullish nature of the signal. But towards the end of the chart, the interaction with the MACD is basically useless. It really degenerates into a useless, choppy whipsaw, as we'd like to call it. And when that happens, you have to ignore the crossover signals or you'll get chopped out to death. And this is that point of a poor signal area where the MACD becomes range bound. You can see a lot of crossovers, and these signals are very difficult to understand what is going on with the trend. You should really look at different things in this scenario. But not only can you look for crossovers with the signal line, but you can also look for the Macd09 crossovers. And this is when the MACD crosses from negative to positive, as we mentioned before, or positive to negative. MACD crossing above the 0 line is considered to be a bullish sign. MACD crosses above its 0 line, that's normally a bullish sign. MACD crossing below its 0 line is normally a bearish sign. And we must recall that when the MACD is equal to 0, that is because the moving averages used in its construction are equal. So the signals generated with this method are exactly the same as the signals you'd get from looking for crossovers between the 12 exponential moving average, remember the default MAs, or EMAs in this case, and the 26 exponential moving average. Here's an example of zero-line crossovers working relatively effectively as signals in daily oil prices. This will work better when the market is in trend line. So like in this example, if the market moves sideways for a prolonged period of the time, the MACD could start whipsawing above and below the zero line, generating too many false signals. So take that into consideration when deciding whether or not to look at zero line crossovers. You see in this situation we have a fair bit of whipsawing, but when you have a clarity, the crossover occurs here. You would take that as a bullish sign if you went long on oil CFDs, WTI crude oil CFDs at around $28. You could simply ride it up until the signal changed, which would get you $10 worth of profit in this circumstance, which is interesting. It doesn't work all the time, but this is a great example of a clearly trending market on the daily. And finally, one of the most effective ways to use the MACD is to look out for divergence. The MACD is especially good at detecting trend exhaustion via divergence because it is not normalized. And divergence is when a new price extreme is not confirmed by a new oscillator extreme. It is a sign of potential exhaustion in the trend. Bearish divergence is when price makes a higher high, but the MACD fails to make a higher high, so it makes a lower high. Remember, bearish divergence is when the price is making higher highs, but the MACD makes a lower high. The MACD doesn't confirm the price making new highs. That is normally a bearish sign. It signals potential exhaustion in the trend. But what if we look the other way around, where you had bullish divergence? Well, that's when the price makes a lower low, but the MACD fails to make a lower low. The MACD has a higher low, which is a bullish sign. You'd think, okay, the flushing of sellers in a particular stock seems to be occurring. You have a point where you have selling liquidity drying up, and buying liquidity is the same, where you see the price break out eventually after that. That is a result of bullish divergence. When you have the price making a lower low, but the MACD doesn't confirm the bearish nature of the price action, and that's where you see normally reversals in price action. So let's probably look at an example. This is an example of divergence in the MACD. The first is a bearish divergence, where the price is making new higher highs. This is on the left side of the screen. But the MACD in this case stops following because it starts making lower highs. That is your clue that the uptrend is running out of steam. If the uptrend still had good momentum, the MACD would be making higher highs still. Just for those who couldn't follow along, look at this point. Higher highs in price on the graph we're looking at, and you have lower highs in the MACD. And what's interesting, you have that bearish divergence, price actually goes down after that, and this MACD signal here, this sell signal, essentially bearish divergence, had confirmed that the trend, that the uptrend, the positive price action was coming to an end. And so you would normally look to go short around this level because you had a simple signal like that. But then after the downtrend, we have a bullish divergence at this section here that we're trying to highlight. And that bullish divergence is shown by a price making a lower low. Look at it, price makes lower low, but the MACD is unable to push lower. It doesn't go lower than where it was at this point. Instead, it actually makes a double bottom. So really, if we look at it, it's a slightly higher low. So it still works with what we talked about. And again, this is saying that the downtrend is exhausted and a reversal is needed. And lo and behold, you had a reversal to the upside. It's important, though, to know that divergence isn't a timing indicator. Divergence can persist for a long period of time before the reversal actually happens. So don't rush to make decisions as soon as you identify divergence. You'll have to use other indicators and methods to find more precise signals or triggers once the divergence is identified. So, to conclude, the MACD is a very popular and extremely useful indicator. It gives a remarkable insight into the momentum of trends, if you know how to use it correctly, that is. The most basic ways to use the MACD are signal line and zero line crossovers, and these are the easiest ways that you can use the MACD, but they are not that reliable. So to really unlock the main benefits of the MACD, you have to try to look at it in terms of overbought conditions and divergence, which means getting some experience so you get better at correctly identifying significant overbought and oversold levels, and also combining the MACD with other areas of technical analysis to find higher probability setups.